Chapter 6: Reporting and Analyzing Inventory. Our learning objectives are: 1. Describe the steps in determining inventory quantities. 2. Apply the cost formulas using specific identification, FIFO, and average cost under a perpetual inventory system. 3. Explain the effects on the financial statements of choosing each of the inventory cost formulas. 4. Identify the effects of inventory errors on the financial statements. And 5, but not least, demonstrate the presentation and analysis of inventory. Determining inventory quantities. Whether companies use a perpetual or periodic inventory system, they need to determine their inventory quantities at the end of each accounting period by physically counting their inventory. And the reason for this is: 1. To check the accuracy of their perpetual inventory records, and to determine the amount of inventory lost due to shrinkage or theft. So if the inventory shrinkage has occurred, the inventory account must be adjusted and an expense related to the shrinkage recorded as well. So how do we determine the ownership of our goods? Prior to counting inventory, we need to consider the ownership of goods in order to ensure that all goods owned by the company are included in the inventory count, and that goods on hand but not owned by the company are excluded from the count. Goods in transit at the end of the period, whether it is on the truck or on board, make determining ownership a bit more complicated. The company may have purchased goods that have not yet been received, or it may have sold goods that have not yet been delivered. The rule to follow is straightforward, really. It is: goods in transit should be included in the inventory of the company that has legal title to the goods. If the shipping terms are FOB destination, the seller has legal title to the goods while they are in transit. If the shipping terms, however, are FOB shipping point, the buyer has legal title to the goods while they are in transit. These terms are very important in determining the exact date when a purchase or sale should be recorded and what items should be included in inventory, even if the items are not physically present at the time of the inventory count. In some lines of business, it is usual to hold goods belonging to other parties and sell them for a fee without ever taking ownership of the goods. These are called consigned goods. Under a consignment arrangement, the holder of the goods, this is called the consignee, does not own the goods. Ownership remains with the individual or the company that wants to sell the goods, this is who is called the consignor, until the goods are actually sold to a customer. Now, goods taken home on approval by a customer are still owned by the company. Taking inventory. Inventory counts are part of a company's system of internal control. Internal controls are systems designed to help an organization achieve reliable financial reporting. Their systems include control activities, one of which is review and reconciliation. Counting inventory is a good example of this control activity. In a perpetual inventory system, the results of the physical inventory can be compared or reconciled with the information in the company's inventory system. Inventory cost formulas. Once inventory quantities are counted, they must apply unit costs to determine total cost of inventory. Units of the same inventory can be purchased at different prices. Is that true, guys? So for example, think about Superstore. If they bought, say, Campbell's soup 3 weeks ago, and then they got to order the same today, Is it going to be at the same price? It can and it cannot be. So if it is different, which cost should they use? Normally they use today's price. Specific identification. The specific identification cost formula tracks the actual flow of the goods in a perpetual inventory system. This cost formula is used for inventories that are composed of unique identifiable items. So for example, think of a car dealership who sells, very expensive vehicles such as Maserati, for example. In that case, where the owner would actually know the price of each Maserati vehicles because they're very unique and they're identifiable. Another example, think of say an art dealership. If you were to go to an art dealer, do you think the art dealer will know the cost of each of their prized arts? Yes, and that is so because they're easily distinguishable. So again, the actual cost of each item can be determined, and the goods produced and segregated for a specific project. Cost formulas assume a flow of costs that may not be the same as the actual flow of goods. So when you buy something, that doesn't mean that you're going to sell it right away. There are two methods for costing merchandising products, something called FIFO, or first in, first out. This means that the cost of the first item purchased is cost of the first items sold. Then there's average cost. This is the cost. The cost is determined using a moving or weighted average of the cost of the items purchased. First in, first out, or otherwise known as FIFO. The merchandise inventory is recorded at the most or recent or current cost in the current assets section of the statement of financial position. So with FIFO, if we purchase something 2 weeks ago, this is going to be the first one sold. The cost of goods sold is recorded as an expense at oldest inventory cost on the income statement. The ending inventory and cost of goods sold under FIFO are the same for periodic and perpetual inventory systems. So as an example, if you were to go to any supermarket and into the section where they sell the milk, have you ever noticed anyone climbing towards the back or reaching towards the back to get the most recent milk? So this is what FIFO is about, right? The stores are usually keep the most recent milk towards the back, and the ones that have been purchased for some time is more towards the front. So people who are looking for the most recent milk, they are reaching towards the back to actually get that most recent milk. This is an example of a perpetual inventory schedule using the FIFO method. Note that on page 307, we have the data of this information. We're going to be going through step by step. So on January 1st, we have our beginning inventory of 100 units at a cost of $10. Now that equals to $1,000 for the total. Then on April 15th, we purchased 200 more units of merchandise at a cost of $11. And that equates to 2,200. Note that each time we bring the balance over. So we have 100 at 10 and then 200 at 11, which totals 3,200. Now, on May 1st, we have our first sale of 150 units. So using the FIFO method, we actually put it into the cost of goods sold area, right? Where we are selling the first goods first. The first set of units is 100 at 10, and then we need to get 50 more, so that's 50 at 11. So we put that into the cost of goods area, and that totals 1,550. Now we bring over our balance each time. So we first had 200 units, so now we have, from that 200, we have 150 left at 11, and that gives us a total of $1,650. Then on August 24th, we purchased 300 more units at $12, which totals $3,600. We bring our balance across where we had a remainder of 150 units at 11, and now the new purchases of 300 at 12. We total those figures together and that gives us $5,250. On September 10th, we have another set of units that we're selling. So our sales, the total on September 10 is 400 units. So how do we do that? We first sell what we had first. So in our balance area, we had 150 units at 11. So we put that down in our cost of goods sold area. And then from that 400 units, 400 minus 150 gives us 250 units remaining. So we put 250 units at $12, which the total of both is $4,650. Now, in our balance area, what is remaining from that 300 units? 300 minus 250 give us 50 units remaining at $12, and that gives us $600 for the total. November 27th, we have another purchase. We're purchasing 400 units at $13. That is $5,200. Then we go over to our balance area where we have 50 units remaining at 12, and we add our new purchase of 400 units at 13. The total of that together is $5,800. Note that the columns that we total together are on the purchases side. We add up all of our units. So we have 200, 300, and 400 units, which gives us a total of 900. We add up our total column for the purchases. 2002, 36, and 52 gives us 11,000. Our cost of goods sold area, we add up all of the units. 150 plus 150 plus 250 gives us 550. And our total, 1,550 plus the 4,650 gives us 6,200. We do not add the balance section. In order to put this into practice, we'll be doing problem 6-3b on pages 344 to 345 in class. Average cost is used when physical flow of inventory cannot be specifically measured. Under a perpetual inventory system, a new weighted or called moving average is calculated after each purchase. It is used to record the cost of goods sold and ending inventory. We'll now have a look at an example of what this looks like. So this is an example of our average cost using the perpetual inventory schedule. Note that we're still using our data on page 307. So on January 1st, we start off with a balance of 100 units for beginning inventory at $10, which gives us 1,000. Then on April 15th, we have a purchase of 200 units at a cost of 11, which is 2,200. Note that we bring our balance across. We add our 100 units plus 200, which totals 300 units. Then we add our total amount of 1,000 plus 2,200, which gives us 3,200. At this point, this is where we calculate the average cost. The formula for the average cost is the cost of goods sold, the cost of goods available for sale, divided by the units available for sale. That's equal to our weighted average unit cost. So in this case, we divide our 3,200 divided by 300, which equals 10.67 for our average cost. Then on May 1st, we're selling 150 units at 10.67, which totals 1,600. Our balance remaining from that 300 is 150 at 10.67, which gives us 1,600. Then on August 24th, we have another purchase of 300 units at $12, which totals 3,600. For our balance, we bring our balance across by adding the 150 units remaining plus our new purchase of 300 units, which totals 450. Then we add our total columns. 1600 plus 3600 gives us 5200. In order to get our average cost, we divided 5200 divided by 450 units, which gives us 11.56 for our average cost. Note that we do not round up our figures. On September 10th, we have our sales of 400 units. So that 400 units is at 11.56, which gives us a total of 4,622. The remaining balance from that 450 minus 400 gives us 50 at 11.56, which totals 577.78. Again, on November 27th, we're purchasing units, 400 units at $13, gives us 5,200. We bring our balance across. The 50 plus 400 gives us 450 units, and our total of 577.78 plus the 5,200 gives us 5,777.78. For our average cost, it is 5,777.78 divided by our units of 450. That gives us $12.84. So, which method do we choose? We choose a formula that best represents as closely as possible the physical flow of goods, and that reports in ending inventory at a recent cost, and using the same formula for inventories of similar nature and usage. We'll continue to do our in-class exercises, problem 6-3B, pages 344 to 345, and problem 6-4B, page 345. Here we have a summary of the advantages of the cost formulas. So we're differentiating between specific identification, FIFO, and average cost. Inventory errors. Errors can occur in accounting for inventory. Quantity or cost assigned to inventory are incorrect. Errors made when recording goods in transit at the end of accounting period. The errors also affect both statement of financial position and income statement through inventory and through cost of goods sold for the income statement. So here we have the effects of inventory errors on our income statement. Note that if inventory is overstated, it's also overstated in our gross profit, our income before income tax, and also our retained earnings. However, understated in our cost of goods sold. If inventory is understated, it's also understated in our gross profit, our income before income tax, and also our retained earnings. But in cost of goods sold, it is overstated. The effect of inventory errors on statement of the financial position. If our purchase of the inventory is recorded too early, then the inventory is overstated, and also then the accounts payable are overstated. However, the cost of goods sold and net income are unaffected, and retained earnings are unaffected. If our purchase of inventory is recorded too late, then our inventory is understated, and our accounts payable are also understated. However, the cost of goods sold and net income are unaffected, along with the retained earnings are unaffected as well. Here's a brief summary of the effect of errors. An error in ending inventory of the current period will have a reverse effect on net income in the next accounting period. As well, an error in ending inventory affects retained earnings of the same period, but not the next period, as the error reverses. Valuing inventory at the lower of cost and net realizable value. When the net realizable value is less than cost, the value is written down. The lower of cost and net realizable value, that is the rule, or LCNRV rule. Net realizable value is selling price less any cost to make goods ready for sale. This is the lower of cost and net realizable value rule. We apply the rule to individual inventory items, reduce inventory by crediting it for the amount of write-down. Debit is the cost of goods sold. Reverse write-down if value subsequently recovers when the conditions that caused the write-downs have changed. We report our inventory in the Statement of Financial Position at the lower of cost and NRV. Also in the notes to the statements, total amount of inventory, cost of goods sold, cost formulas, amount of write-downs or reversals. And there's no significant differences between IFRS and ASPE. Inventory turnover is what helps us to determine how much inventory a company should have. We use two ratios to help us to manage this, and they are inventory turnover ratio, which measures the number of times on average inventory is sold in a period. Also, the days in inventory ratio, which converts inventory turnover ratio into number of days inventory is held. We'll now have a look at these individually. These are our inventory ratios. Note that the higher the inventory turnover and the lower the days in inventory ratios, the better it is. So our formula for inventory turnover is equal to cost of goods sold divided by average inventory. Days in inventory's formula is 365 days divided by inventory turnover.